This conference will now be recorded.
We will get started. Thank you so much for joining us for our fourth quarter webinar titled Investing Fundamentals During Market Volatility. My name is Jenna Witherbee, and for those of you who don't know who I am, I'm one of the advisors on the team at 401k Plan Professionals. We focus 100% of our time on corporate retirement plans, both serving the plan sponsors as well as the employees who participate in the plans. We open up these webinars to anyone and everyone as we want to continuously provide you with value. Today's presentation is a part of our webinar series. Each quarter this year, we've spent about 10 to 15 minutes discussing a variety of topics. In addition to presenting it live, we also sent out the link to the recording afterwards, and we post it on our website and our YouTube channel. Next year, we may even increase the number of webinars that we're doing, so stay tuned for that. I also wanted to mention that you can put any questions that you have during the presentation right in the chat box, and I will try to make sure that I see those. What is market volatility? Stock market volatility is sometimes a misunderstood concept. Simply put, volatility is the statistical measure of the tendency of a market or a security to rise or fall sharply within a short period of time. In other words, it's the range of price change that a security might experience over a short period of time. Volatile markets can make investors anxious or nervous and are usually characterized by wide price fluctuations and heavy trading. And we like to talk about market volatility no matter what's going on in the stock market, but we thought this topic was especially timely with what's been going on in the last 6 or 7 weeks or so. When investing, especially when thinking about investing over a long period of time, like in the case for a lot of us in our 401k, market volatility is inevitable at some point. So it's important to maintain a holistic view and ignore the short-term fluctuations. It's extremely difficult to be successful with timing the market. And so these are 5 investing fundamentals that I'll cover today, which can help you better manage your emotions during market volatility, just like I said, what we've been experiencing over the last 6 or 7 weeks. So number 1, keep your emotions in check. First and foremost, like I said, volatility is inevitable. It's going to happen. So try not to panic when it does arrive. Sometimes less is more during volatile times. So in other words, sometimes taking slight action or even taking no action at all might be an appropriate course of action. Typically, the investors who are making frequent changes, frequent trades, attempting to time the market, those are the ones that are typically at a disadvantage compared to those who stay the course and maybe make no or slight investment changes. If we look back over the last 38 years of the S&P 500, despite intra-year declines in the market, which average over a 13% loss, 29 out of the last 38 years ended with positive performance for the year. I love this slide too. Plan to stay invested. Like I said, trying to time the market is extremely difficult. Market lows often result in emotional decision making. Investing for the long term while managing volatility can result in a confident retirement outcome. This chart is showing the growth of a $10,000 investment in the S&P 500 for the 20-year period. And if that $10,000 remained invested the entire time, the average annual return was 7.2%. But get this, if you miss just the 10 best days during that time frame, the average annual return goes all the way down to 3.5%. And you can see this trend continue as you miss more of the best days of the market, that your annual rate of return goes down significantly. So staying the course is extremely important. Number 2, make sure to have a checkup on your portfolio, in other words, your asset allocation. Our goal is to help you invest properly at all times for your age and your risk tolerance. Therefore, when volatility does come around, you should be able to remain calm. Chances are, if volatility makes you extremely nervous, your portfolio might be too risky for you in the first place. Another thing is that rebalancing should be done periodically so your portfolio always remains invested close to your intended allocation. When selecting an asset allocation, a person's own risk tolerance is a factor to consider, and age is a really important factor as well. This chart shows performance during a 1 year, 3 year, 5 year, 1 year, 5 year, 10 year, and 20 year rolling time frame in the stock market from 1950 to 2017. So you can see that volatility is significantly higher in the shorter time frames, but it lessens as the time frames get longer. And this kind of data is very helpful for us when educating and assisting 401k plan participants with their own asset allocations. In fact, this graphic is something that we actually use to kind of back up what we're teaching and what we're saying. Number 3, diversification. You've probably heard us say this a lot if you've ever come to one of our meetings that we do, but diversification, in other words, spreading out your money among different asset classes, is a way that investors may reduce their risk. Different sectors perform differently over any given period of time. We get these charts quarterly, and they show us how the 9 main sectors of the U.S. stock market have performed over different time periods. So year to date in 2018, just the third quarter of 2018, since the market high in October 2007, since the market low in March of 2009. And you can see that no 2 sectors are identical. Number 4, don't lock in your losses. You may have heard the phrase, don't lock in your loss, or a loss on your statement is a paper loss. Basically, these phrases are saying that it's detrimental to sell when your investments decline. Selling when the market is down locks in that loss instead of giving the investment an opportunity to recover. Number 5 is dollar cost averaging. This is a final fundamental that I wanted to cover today. By definition, it's a strategy to manage or address risk by buying investments in planned intervals rather than a fixed dollar amount. And so if you're participating in a 401k, you're already doing this. You're already having dollar cost averaging on your account, whether you know it or not. This is just an example. And we've actually shown this before, but instead of investing $3,000 in January and selling that investment in December at the same share price, therefore not realizing any return on your investment, if you were to have spread out your $3,000 into monthly chunks of $250 per month, you can take advantage of buying more shares, accumulating more shares of that investment, even when the stock price in the short term goes down. So therefore, when the stock market price goes back up, you have accumulated more. You've returned an investment on your money. So in this example, since the share price, it started at $20 per share at the beginning of the year, and it went down, it decreased to $16 per share near May and June, but went back up to what it originally was. This investor, throughout the course of the year, actually earned over $300 just from the concept of dollar cost averaging. So in this particular example, that's an 11.3% return just from dollar cost averaging. That's pretty cool, right? So that is happening behind the scenes. You can't ever forget about that. Again, here's the 5 investing fundamentals that I covered today, which can help you hopefully strive to feel more comfortable during market volatility. I didn't see any questions in the chat box, but if you have any, and want to quickly write them in there, you can do that, and hopefully I can get to them. But otherwise, thank you so much for joining us this morning. If you have any questions now, or if you think of something later on anything that we covered today, please feel free to reach out to us. We hope you join us for our next webinar that will be in early 2019. Thank you so much, everybody. Have a great day.